If you really want to know if real estate's going to crash, you need to find the weakest link. You came here for the truth, so let me unveil that for you. In today's video, we're going to look at that weakest link. I want you to know exactly what's going on with real estate because it is a very mixed picture. You will find videos that do very, very well on YouTube that are going to tell you real estate's going to crash tomorrow, real estate's going to crash the next week, it's already crashing, it's gone down 20%, 50%, 100%. Wait a second, what? Yeah. Anyway, let's get to reality. Let's actually break down what we have seen, what we are seeing at this time so that we know the truth. Mortgage rates in the US to drop to 5.5% in 2024. So where we are at this time is definitely, no question about it, much lower than where we had been in the last little while. So here is the chart. You can see it for yourself as we look at this. I think, it's important to just understand 6.63%. 6.63% at this time, coming off basically 8%, okay? So it is quite a bit lower, and you can see it's kind of flatlined in the last little while, and we'll see what happens over the next coming months. The expectation is of cutting interest rates and all that, so we'll see how it all comes to be. But that's what's going on in the United States, largely similar to other countries, but that's really the where I want to start with this. Looking at the percentage, it all depends on you, your circumstances, your credit rating, where you live exactly, what kind of property. There's many factors, but in general, interest rates without the Fed funds rate coming down, the borrowing cost, you the individual, that has come down. And that is a good thing for the economy in general, that, the pressure is kind of being released. High borrowing costs have caused sales of previously owned homes to slide to the lowest level in nearly 3 decades. You look at these titles all the time. Lowest sales, the sales are crashing, low inventory. Now inventory has been moving up. What's going on? Well, there's less sales. As soon as things get more attractive, we're going to see more properties come on the market. Will they be at the right price? Depends how many start to come on the market. Right now, there's seemingly an insatiable appetite for single family homes in, really nice areas. That hasn't changed, and likely doesn't change unless there's something catastrophic. Where we have a problem is, well, we'll save the interesting part for last, but certainly condominiums in places where they just build so much and then investors come in to scoop that up. That's a problem. It's a problem in some places anyway. We need to find a few pieces of information. We need to find vacancy rates, which are a little bit clouded in mystery oftentimes. We need to find permits. We need to find, any of the relevant data going on basically in that economy itself, very localized. Once we know that, then we can address, is that a good investment? It's a very local thing. You can drive, a half an hour, and it's a very different circumstance. So knowing that information is the first step. But borrowing costs are the number one factor in determining where we will go, up or down. There's no question about that. Borrowing costs. What about this? This lady right here, the mayor of Toronto. Congratulations. Look, this is what she said. We're talking about, shortages, high prices, all these things, right? In other words, accepting that the Toronto of 2034 will be a lot different from the one we live in today. What does that mean? Well, that's because we're going to have to accepting, among other things, that the dream that has endured for many generations, that if you work hard at a good job, you can own your own house with a patch of grass out front and a mailbox on the porch, is dead, at least for anyone without generational wealth. This is the quote. That is the 1950s and 60s concept that is so done. I could not believe I read this over and over again, that you, the individual, work hard each and every day. You do what you can so that you could afford that home. So you could be like, one of these old shows that you would see on TV where they've got the single family home in the nice neighborhood, and the grass is all manicured nicely. You got the car out in the driveway. Everything is just fine and dandy. There was no concern of, not being able to afford it. I mean, the houses were reasonable. Everything was reasonable. Okay, we didn't have, the Apple Vision Pro that you need to take out a mortgage to get. No, but the basics, if you just measure just the basics, it all made sense. Today, a very different world. What has changed from those many years ago up until now is no question about it. A devaluation of the currency that is being done intentionally in order to separate the haves from the have-nots. These politicians are insignificant. The mayor of a city doesn't really do anything. These are not even puppets. These are just pawns. A record high number of new condos are going unsold in the Greater Toronto Area. Unsold new condo inventory increased 4.1% year over year in the last quarter. This is important, okay, because it's not just in this one place. I show you that just because, it's an extreme example of a city that has so many attractive points to it. Oh, all these people want to come here. Prices are still low in comparison to, let's say, a New York, but there's a lot more development that can happen. It's not overdeveloped at all. So they would say, hey, this is a great opportunity. Let's get investment capital in there. When somebody wants to invest in Canada, they can do that in a few cities. And where we have seen a lot of price acceleration has been Toronto. Of course, Vancouver too. But there's a problem. You start building too much, you got an issue. And this has been now a concern. Why are we going to go out there and invest in a very precarious time? What's going on with real estate? Right now, interest rates are too high. The expectation is that they'll come down. So why would they go get it now? Why not just wait? That's the circumstance we are in right now. We are in limbo. We're in limbo. If there's a recession, if there is a problem, if there is some sort of issue that's not, let's say, mass failures and depressionary scenario, whatever, well, then they're talking about more rate cuts. They're talking about 6 rate cuts before the end of the year in the United States. That's what the market believes. That would be pretty extreme. They're basically pricing in the fact that it's not going to be a soft landing. It's going to be a hard landing. And as a result of that, they're going to cut interest rates. What happens? Risk assets start to go up and real assets start to get more attention. That's what's going on. Keep that in mind. That is really the takeaway. If you appreciate this information, hit that thumbs up button. I do appreciate that myself. You would expect me to welcome Wednesday's remarks by Fed Chairman Jerome Powell that a rate reduction in March is not the Fed's base case. That's a quote. The problem is that this was handled in a way that's unnecessarily robbing the central bank of policy flexibility while lengthening its already long list of recent communication mishaps. What happened here? Jerome Powell came out and had to say, March is not the base case for a rate cut. We don't know what's going to happen and time will tell, but I think it's really important to address it. Okay. When I see this, they want greater confidence. They want to know inflation is coming down. And will it? Is it going to be able to come down? That remains to be seen, but they're going with their stats. They're giving us their data, and that is going to be the number one factor for what happens with real estate. Okay. They are going to basically move. The big players are going to move based on what happens with the Fed. They're waiting and they're seeing. The expectation is that they'll cut this year. If that happens, look out. It's going to be interesting. Let me tell you. Markets are still pricing about 6 cuts over the course of this year. This suggests to us that they are pricing in a policy error. That means the way that they're leaving interest rates at the level they are right now is a mistake. That's what the market believes. When we talk about the market, we are looking at swaps. We're looking at futures. These are all, these investors, what they love. All you need to know is that investors believe there's going to be a lot of rate cuts before the end of the year. I think that's something unusual. The challenge here is that whose advice do we take? Do we take the market? Do we take the investors? Or do we look at the Jerome Powells of the world and take what they say at face value? The market in this respect is generally pretty accurate. The only problem though, Jerome Powell, scratches his nose and, the market changes its mind very rapidly. So it's not consistent. That's the issue. Keep that in mind, okay? Just basically just saying, what they're talking about with rate cuts. Buyers in Canada are starting to venture back into the housing market, seeking to get ahead of any possible shopping frenzy spurred by the expected rate cuts for the Bank of Canada. And unusual sales rally in December has stoked speculation that the Canadian housing market may start to heat up even more. We're in what's supposed to be like the bottom, quiet, and activity starts picking up. Crazy. I don't think that we're the only ones who have saved for a down payment in the last 3 years. It will go back to people getting excited with the rates getting lower, and people are just going to get a little crazy and going into a buying frenzy. It's already crazy. What was happening was people were lining up outside of houses, and then they would just go in one at a time, putting in an offer. What kind of world are we living in? Just for a regular house? Some cases, you're talking about 50, 80, 100-year-old homes. Maybe they're renovated a little bit, this and that, but that's the circumstance. That's the euphoria, and we will get there again. What about a crash, though? Well, I think the biggest issue comes with commercial real estate. That's where the problem lies. Why? Number one, mass vacancies in many cases. When we look at office, when we look at retail, some places are they're doing pretty good. They're strong. They're not what we saw in 2020, but they withstood that damage of 2020. Businesses went bankrupt, but overall, not as many went bankrupt as was expected because the government pumped in a lot of cash. Knowing that, we can expect it again. And what was the end result of this? Was a devaluation of your currency, making prices higher. Prices on everything. So you can expect more of that in the coming days, weeks, and months. Commercial real estate is, in fact, the weakest link. I'll go into that more in depth in other videos. If you want to know the truth, you got to understand the financial education that I bring to you for free. themoneygps.com. Click on that button that says Compass. This is a free financial education short course that is purposely built so that you can share that link with your friends, family, coworkers, and so on, because I don't get into anything with the Fed. I don't talk about anything of the depths of the Rothschild family, none of that. And it does not link to my social media. It does not link to any of my YouTube videos at all. It is pure financial education made super simple. Videos that are like a minute, 5 minutes, like super short. And you go through the whole thing and you get that financial education. You've got to get that foundation for yourself, for your friends, family, and you don't want to, necessarily share the regular YouTube videos. Well, then this is the thing. themoneygps.com. Click on that Compass link, and that's the one. I really appreciate when you do that. Of course, don't forget to hit that thumbs up button. And always, I want to see you back here tomorrow. Take care.